Welcome to the deep dive. Today we're plunging into the AES Corporation, ticker symbol NYSE, AES. Now this is a company aggressively pushing into renewable energy, signing some really huge contracts, especially with tech giants. But here's the central question we really need to unpack. Can AES, with its, well, significant financial pressures and that towering debt, can it truly deliver on that ambitious future? Or will these challenges just prove insurmountable? So our mission in this deep dive is pretty straightforward. We've taken a stack of carefully selected sources on AES. It's a Fortune 500 global power company, and we're going to extract the most important insights. We want to give you a shortcut, really, to being truly well-informed on what seems like a critical juncture in the company's history.
Yeah, and just to set the stage quickly, our analysis today is as of June 21, 2025. For context, AES closed yesterday, June 20th, at $10.41 per share.
Okay. We've structured this deep dive into two clear parts. In part one, we'll lay the foundation. We'll cover AES's core business, its management team, and the crucial financial picture. Then, in part two, we'll pivot. We'll look at market sentiment, ownership, a pretty comprehensive risk assessment, and then finally, our overall conclusion. And before we jump right in, just a quick note. If you're finding this deep dive valuable, please remember to like and subscribe to the Stock Analytics AI YouTube channel. For just $4.99 a month, our members get priority deep dives on specific tickers. And over the next few months, we're actually covering all of the S&P 500 stocks exclusively for members, so don't miss out on that. Right, let's get started with Chapter 1, Business Understanding. What immediately strikes me about AES is their distinctive business model. They call it strategically bifurcated, which essentially means they operate two very different yet interdependent segments, generation and utilities. Could you unpack what that actually means and maybe why it's so critical to their whole strategy?
Absolutely. Think of generation as their high-growth engine. It's a global renewables developer focused on building new solar, wind, and battery projects. The key thing here is their focus on these long-term fixed-price power purchase agreements, PPAs they're called, often with corporate giants like Amazon and Meta. These PPAs basically lock in predictable revenue for years, which makes these massive, expensive projects financially viable.
Ah, okay.
Then on the other side, you've got the utility segment. That's their stable foundation. This involves regulated generation, transmission, and distribution. And the revenue is set by public utility commissions. So this regulated predictability provides a crucial financial bedrock. It essentially de-risks and supports the more dynamic, higher growth generation business. It's kind of a unique hedge, really, that few pure-play developers can replicate.
So it's not just about diversification, it's actually a strategic funding mechanism. Interesting. Speaking of what they generate, what's their current energy mix look like, and what are some of the other core products beyond just, selling electrons?
Right. So their installed capacity as of the end of 2024 was 32,109 megawatts.
Right.
Roughly 50% comes from renewables now, then about 32% from natural gas, 16% from coal. They're phasing that out mostly, and the rest, a tiny bit, from pet coke and oil. But like you said, it's not just power generation. Their utility segment serves 2.7 million customers in the U.S. That's AES Indiana and AES Ohio, and also in El Salvador. A major growth area, and this is important, is energy storage solutions, notably through their Fluence joint venture, where they're actually a global leader. And they're also innovating with technologies like Maximo, which is an AI-powered robot helping build solar farms faster, and Uplight, a cloud platform for utilities.
Yeah, that leadership in corporate PTAs and Fluence really does stand out. A Fortune 500 company operating in 10 countries, they've clearly cemented their market position. So what's the core value proposition they're offering to their diverse customer base? I mean, from tech giants all the way down to homeowners.
Well, their primary value proposition, as they put it, is to accelerate the future of energy. For corporate customers, especially those with massive and, frankly, growing energy needs, AES offers customized carbon-free solutions. These directly help them meet their own ambitious sustainability goals. For the regulated utility customers, it's more about safe, reliable, and affordable electricity, plus the critical modernization of the grid. And then for investors, AES presents itself as a direct way to invest in the global energy transition, aiming to combine that high growth from new renewable projects with the underlying stability of their regulated utility assets.
And those global trends couldn't really be more aligned with AES's strategy, could they? We're seeing this dominant global shift to renewable energy. The IEA, I think, projects renewables will cover all the world's electricity demand growth in 2025. But then there's this other, maybe even more explosive trend, the surging electricity consumption from data centers and AI. U.S. data center demand alone could jump by, 60 gigawatts by 2030. How does AES position itself in that AI revolution.
Yeah, it positions them as a foundational picks and shovels provider, essentially.
Right.
As AI demands just unprecedented amounts of power, companies like AES, with their expertise in large-scale clean energy generation and grid solutions, they become indispensable partners. They're literally building the infrastructure that powers this revolution. However, these opportunities don't come without significant headwinds.
Right. Always a catch.
Always. Inflation and rising interest rates directly impact their project financing and electricity prices. It makes it more expensive to fund these big new projects. Plus, you've got geopolitical forces at play, things like protectionist trade policies, maybe tariffs on energy components, and this trend of friendshoring supply chains, basically, realigning sourcing to politically allied countries for more security that could potentially impact costs and timelines for a global operator like AES.
That gives us a good sense of the macro picture. When you look at their direct competitors, specifically in North America, how does AES stack up against the Goliaths like NextEra Energy, Duke, or Southern Company? What's their differentiator?
They're certainly up against some formidable rivals. I mean, NextEra is a giant, much larger market cap leading position in U.S. renewables, Duke, Southern, Exelon. They're also making significant clean energy investments. AES seems to differentiate itself through its focused strategy on those corporate PPAs we mentioned. That allows them to capture a specific high-growth market segment. And their leadership in energy storage via that Fluence joint venture is another key differentiator. It provides critical tech for grid modernization and integrating renewables.
And the regulatory environment, it sounds like a minefield, but also maybe a catalyst. Policies combating climate change, like GHG emission reductions, renewable portfolio standards, those seem like clear tailwinds. And the U.S. Inflation Reduction Act, the IRA, that offers crucial tax incentives. But what are the significant regulatory risks here?
Well, while the IRA is definitely a powerful driver, there's always political uncertainty, right, around its long-term stability or maybe future revisions. Beyond that, AES has to navigate really stringent environmental laws, air, water, coal ash disposal across multiple jurisdictions. That's complex. And of course, state-level rate setting for their regulated utilities introduces another layer of complexity and potentially constraint on their earnings.
Despite those risks, the industry itself has some pretty formidable barriers to entry. We're talking high capital intensity, right? Multi-billion-dollar projects are the norm. Makes it tough for new players to even get started. Then there are the regulatory hurdles permitting interconnection backlogs that can stretch, over 4 years? Plus, you just need deep technical expertise and serious economies of scale to manage a diverse global portfolio like AES has.
Exactly. And building on that, AES benefits from several distinct competitive advantages. Their strong brand and corporate decarbonization. I mean, look at their PPAs with leaders like Meta and Amazon. That speaks volumes. Their global scale and their domestic supply chain strategy offer cost advantages. The long-term nature of PPAs and those regulated utility monopolies mean high customer switching costs, which helps ensure predictable revenue streams. And their unique assets, like Fluence's leadership in storage, their market-leading LNG infrastructure, innovative tools like that Maximo robot, they truly do set them apart.
Okay, let's transition now. Let's talk about Chapter 2, Management Evaluation. Andres Guski has been CEO since 2011. He's overseen this major strategic transformation towards clean energy with the goal, I think, to exit most coal by the end of 2025. He's been recognized for his leadership, multiple Edison Awards, sits on important boards. But beyond the accolades, what's the management team's actual track record? Especially, things get tough.
It's actually a pretty remarkable track record in crisis response. We saw it recently when AES Ohio rapidly restored power to, 136,000 customers in just 36 hours after those 2024 storms. They also led significant relief efforts after Hurricane Maria in Puerto Rico, and they navigated the complexities of the COVID-19 pandemic pretty effectively. And this resilience wasn't just learned recently. It was kind of forged through earlier challenges, the economic crises in Argentina and Brazil back in the early 2000s, even the fallout from the Enron collapse. That forced a fundamental shift in their operating model back then. So yeah, it's a team that has definitely faced fire before and adapted.
That depth of experience is certainly reassuring. They also seem to prioritize transparency, active investor relations, detailed reports, and their ethical reputation seems solid, consistently recognized 12 consecutive years as one of the world's most ethical companies by Ethisphere. That's not nothing. So how does this management team allocate capital in a company that's clearly so capital-intensive and focused on growth?
Well, they prioritize reinvestment, primarily into that massive renewables pipeline currently sits at an 11.9 gigawatt backlog, and also into modernizing their utility infrastructure. Historically, M&A, mergers, and acquisitions was more for entering new markets. But more recently, it's shifted towards what they call capital recycling. This strategy involves selling off mature or non-core assets, like their stake in AES Brazil, or they sold a portion of AES Ohio to CDPQ, the Canadian pension fund. The idea is to use that cash to fund new, high-growth projects. They've announced or closed $2.8 billion of a targeted $3.5 billion in asset sales through 2027. And the explicit goal here is to avoid issuing dilutive equity. This self-funding model, though, it's a bit of a high-wire act. Its success really hinges on timely asset sales at good valuations.
Right, trying to fund growth without diluting shareholders, that makes sense. And it explains why we don't see significant share buybacks. They seem to be prioritizing projects and debt management. But what about direct shareholder returns? They've maintained a pretty consistent and growing dividend, haven't they?
They have indeed. They've increased their dividend for 12 consecutive years now. For fiscal year 2024, it was 69.8 per share, and they've announced about a 2% increase for 2025. However, management has signaled slower dividend growth going forward, maybe 2–3% after 2024, again, to prioritize that reinvestment into the business and managing the debt load. And this brings us to a really critical measure for a capital-intensive company like AES, return on invested capital, or ROIC.
Ah, yes, ROIC.
Their historical ROIC has been quite volatile and frankly low. For example, 4.46% in 2024 and about 3.8% on a trailing 12-month basis. Now, an ROIC below their weighted average cost of capital, their WACC, that indicates value destruction. So the entire bull case for AES essentially rests on the bet that the future ROIC from all these massive new renewables projects will substantially exceed their WACC, justifying this very aggressive investment strategy.
Okay, that sets things up nicely. Let's move into Chapter 3. Financial analysis. This is where the numbers really tell a compelling story, or perhaps a cautionary one. As of June 2025, AES's market cap stands around $7.41 billion. So that positions them as a significant mid-cap player, definitely, but still considerably smaller than giants like NextEra Energy, which is way up $147 billion.
Right. And looking at revenue growth trends, we've seen considerable volatility over the past 5 years. It's been a bit choppy. While revenues jumped over 15% in 2021 and 13% in 2022, they've actually shown slight declines, around 3% in both 2024 and the trailing 12 months ending Q1 2025. This kind of lumpiness is, well, pretty characteristic of a company going through a major transformation like AES is, with asset sales and project development cycles directly hitting that top line.
And that transformation seems to be reflected in their profit margins too, doesn't it? We've seen some compression over recent years. Gross margin dropped from nearly 28% back in 2020 down to, 17.63% in the trailing 12 months ending Q1 2025. Operating margin saw a similar decline, and net profit margin has been particularly volatile, even negative in 2022 and 2023, before bouncing back recently.
But the most critical financial story here, I think, is free cash flow, FCF. It has been consistently and increasingly negative. And that's a direct consequence of their massive capital investment cycle. After actually being positive back in 2020, their cash burn just accelerated dramatically. It hit nearly $4.7 billion negative in both 2023 and 2024. For the trailing 12 months ending Q1 2025, it was still a significant negative $3.49 billion. This just highlights their heavy reliance on external financing and those asset sales we talked about to fuel their growth ambitions. It really is the financial tightrope they're walking.
And this cash burn stands in pretty stark contrast to management's preferred metric, that non-GAAP adjusted EPS, which shows a fairly steady upward trend. Meanwhile, GAAP EPS, the standard accounting measure, is often negative because of non-cash items like impairments and foreign exchange impacts.
Okay.
So there's a real chasm, you could say, between these two views of profitability. For you, the listener, the crucial question is probably which narrative you prioritize when evaluating the company's performance.
Exactly. And that leads directly to their financial stability, or maybe lack thereof in some areas. AES's leverage is notably high. Their debt-to-equity ratio was around 3.42, or 342% as of March 2025, total debt exceeding $30 billion. Now, that is significantly higher than their peers and makes them very, very sensitive to interest rate changes. Their current ratio is also quite tight at 0.84, meaning current liabilities exceed current assets. That's largely due to those massive ongoing construction programs.
Right. Despite those pressures, though, their dividend stability and growth do stand out. As we mentioned, 12 consecutive years of increases. That offers a pretty robust forward dividend yield right now, around 6.7%. And the dividend is well covered by earnings, looking at the 38% payout ratio. However, and this is a big However, it's crucial to reiterate, it is not covered by their negative free cash flow, which means new debt or those asset sales are essentially supporting the dividend payments at the moment.
Yeah, that's a key point. Now, in terms of valuation, AES appears significantly undervalued, at least on a relative basis. Its trailing 12-month price-to-earnings ratio is way down around 5.6x. That's a stark discount compared to Nextera's 26.7x or Duke's 19.0x. This very low multiple strongly suggests the market is pricing in substantial risk. So the critical question here becomes, is AES a deeply undervalued growth story just waiting for a re-rating by the market? Or is it potentially a classic value trap due to its high leverage and persistently negative free cash flow?
The value trap question. To try and get a sense of its underlying worth, we often use a discounted cash flow or DCF model. This is basically a way to estimate what the company is truly worth by summing up all its expected future cash flows, discounted back to today using the weighted average cost of capital, or WACC.
Right. And our educational DCF model, which tries to factor in their high leverage and international operations risk, suggests an estimated intrinsic value range for AES of nowhere between $12 and $18 per share. Now, key assumptions there include a 10-year forecast period, a WACC between 7.5% and 8.5%, reflecting that higher leverage and international risk, and a terminal growth rate of 2.0% to 3.0%.
Okay, welcome back for part 2 of our deep dive into AES. We're starting this part with Chapter 4, Market Sentiment. The prevailing sentiment among Wall Street analysts seems to be a moderate buy, but this really masks some deeply polarized views underneath. While a majority do have strong buy or buy ratings, there's a notable contingent holding hold and even some sell ratings. The average price target sits around $14 to $15.35, suggesting significant potential upside from the current price. But the range is exceptionally wide, like $5, $7 on the low end, up to $23 or even $29 in the high end. That clearly signals a battleground stock, and recent analyst actions have definitely trended more cautious, with some downgrades coming through.
Yeah, and the impact of recent news is quite telling, isn't it? Positive operational announcements, things like the big Belfield solar project for Amazon or those large PPAs with Meta, they've often been met with, well, investor skepticism. The market seems laser-focused on the immense capital expenditure and the debt required for these contracts, maybe more so than the long-term revenue potential. Conversely, negative news, like the Q1 2025 earnings miss they had, that directly led to stock declines and further downgrades. The general media tone seems to reflect this cautious to bearish sentiment overall.
And one of the clearest market indicators of this bearish sentiment is the elevated short interest. It stands at 6.18% of the company's float. That's nearly 6 times the utility sector average, which is way down at 1.3%. This represents about 43.7 million shares sold short. It signals really strong bearish conviction that AES faces near-term headwinds. It's like they're betting heavily on those risks we discussed earlier.
Absolutely. And the technical indicators, the charts, visually represent these market concerns quite well. The stock's price, around $10.41 now, is currently trading below its 50-day moving average, which is somewhere between $10.61 and $11.28. That indicates a bearish short to medium-term trend. The long-term picture is even more stark. The price is significantly below its 200-day moving average, which is up between $11.42 and $14.26, and has been consistently below that 200-day moving average since way back in October 2024. This just confirms a persistent downtrend, reflecting widespread market apprehension.
Okay, let's move on then to Chapter 5, Ownership Structure. AES has exceptionally high institutional ownership. We're talking 88% to 93%. This means large money managers think Vanguard, BlackRock, State Street. They're the top 3 holders. They largely dictate the stock's performance. Their significant presence, especially from passive index funds, accounts for a huge portion of the shares outstanding.
Right. And if we connect this to the bigger picture, recent 13F filings from these key players show pretty mixed activity. It really mirrors the polarized debate around the stock. While some institutions like State Street and Orbis have been adding to their positions recently, others, including the giants Vanguard, BlackRock, and FMR Fidelity, have actually reduced their stakes. This divergence among the largest owners is quite telling, I think, and it highlights that ongoing internal debate about AES's future prospects.
And in stark contrast to that massive institutional ownership, insider holdings are very low, like 0.47% to 0.48%. This suggests that executives have relatively little personal capital directly invested in the company's stock. We've also seen more insider sales than open market buys over the last 12 months. Now, most of these were non-discretionary transactions related to compensation plans. But crucially, there have been no open market buys by key officers in the last 3 months. You have to wonder what that signals, right? In terms of management's conviction at these current price levels?
Yeah, that low insider buying combined with the high ownership concentration where the top 25 shareholders own about 65% of the company and the top 3 control nearly 25%. It means the stock's price can be heavily influenced by the trading decisions of a relatively small number of major asset managers. This can definitely lead to increased volatility, both up and down.
Makes sense. Now let's conduct a Chapter 6, risk assessment. We'll use a classic SWOT analysis framework: strengths, weaknesses, opportunities, threats. Let's start with AES's strengths. First, their strong renewable energy leadership, 50% of capacity now from clean sources. That's significant. Second, a truly diversified global portfolio operating in 10 countries, various technologies. That provides some resilience. Third, that robust contracted backlog, 11.9 gigawatts of new projects under long-term PPAs offering visible growth potential. Fourth, there's stable utility operations, which act as that kind of bedrock of regulated earnings we discussed. And finally, their innovative capabilities, things like Fluence and their Maximo robot, positioning them for future tech shifts.
Okay, turning to weaknesses. The most significant, undoubtedly, is their high debt load. That debt-to-equity ratio exceeding 3.4x makes them highly vulnerable, especially to rising interest rates and any economic downturns. Directly related to this is their persistently negative free cash flow. That represents a massive cash burn and a continuous need for external capital, either more debt or asset sales, to fuel operations and growth. They also experience earnings volatility and foreign currency exposure due to their international footprint, and there seem to be ongoing challenges in achieving top-tier operational efficiency.
All right, now for the opportunities. There's clearly massive demand coming from data centers and AI, positioning AES strategically as potentially a primary energy provider for this surging industry. The broader global energy transition itself is a huge multi-trillion-dollar tailwind they can ride. Energy storage and grid modernization offer significant growth avenues, especially given AES's leadership in that critical enabling technology through Fluence. And their established presence in emerging markets, particularly Latin America, provides a platform for continued expansion there.
Finally, this raises an important question about the threats. Regulatory and political risk is substantial. Uncertainty around the IRA's future, stringent environmental compliance requirements. These could potentially drive up capital expenditures unexpectedly. They face intense competition, not just from other large utilities, but also private equity firms, which can compress returns and make project acquisition more challenging. Technological disruption is always a possibility, right? New, more efficient energy technologies could emerge rapidly. Macroeconomic factors are critical too. AES is extremely sensitive to rising interest rates, which increase their cost of capital, and inflation, which drives up project costs. Lastly, geopolitical factors like tariffs on energy components and this whole trend of de-risking global supply chains. It creates a really complex operating environment for a global company like AES.
Okay, let's try and bring it all together now with Chapter 7, conclusion. Let's quickly recap the core bullish points. First, AES looks like a pure play on major megatrends. You get direct exposure to the global shift to renewables and that surging demand from data centers and AI. Second, they have visible and contracted growth ahead. That 11.9 gigawatt backlog under long-term PPAs with creditworthy customers provides a seemingly de-risked path to future earnings and cash flow growth. Third, the company appears deeply undervalued relative to its peers. That very low PE ratio suggests potential for a significant multiple expansion if they execute well. And fourth, for investors looking perhaps for stability or income, there's an attractive and seemingly secure dividend yield of around 6.7%. It's well covered by earnings, offering reliable cash returns for now.
Right, but countering that, the bearish points are equally compelling, perhaps even more so for some. First, AES carries a crushing debt load, over 3.4 times debt to equity. That makes the company financially fragile, especially vulnerable to rising interest rates or economic downturns. Second, there's the massive and ongoing cash burn. Billions in negative free cash flow annually means they are heavily reliant on the capital markets and those asset sales continuing smoothly. Third, there's significant execution risk. Building out a nearly 12-gigawatt pipeline across multiple countries is just a monumental challenge. It's prone to delays, cost overruns, supply chain disruptions. Lots can go wrong. And lastly, there's that potential for it to be a classic value trap. The low valuation might actually be justified by these substantial financial and execution risks. The stock could just remain cheap or even fall further if they stumble.
And just to remind everyone, our estimated intrinsic value range from the educational DCF model trying to balance all these factors came out at $12 to $18 per share.
Yeah, and what's fascinating here is that AES's current share price, around $10.41, is actually trading below the low end of that estimated intrinsic value range. This really suggests the market is heavily discounting the company's execution ability and its significant financial pressures. So this raises an important question for you, the listener. AES represents a high-risk, potentially high-reward investment. It's pretty clear-cut in that sense. The entire investment thesis is really a clear bet on management's ability to execute almost flawlessly. For the stock's market value to truly converge with its intrinsic potential, management absolutely must deliver on three critical fronts. One, consistent and profitable execution on its massive project pipeline. Two, successful completion of its capital recycling program to delever that balance sheet. And three, perhaps most importantly, they need to begin that long-awaited transition from burning cash to generating substantial, positive, and growing free cash flow. Until tangible progress on these fronts is evident, the stock is likely to remain a pretty volatile battleground.
A tug-of-war between bulls focused on the future potential and bears fixated on the very real present risks. What truly stands out to you about this complex energy transformation story?
That wraps up our deep dive into the AES Corporation. We really hope this gave you a useful shortcut to being well-informed on this really fascinating company. And if you want more deep dives like this one, please remember to like and subscribe to the Stock Analytics AI YouTube channel. You can join our members for just €4.99 a month and get priority access to deep dives on all S&P 500 stocks, which are coming your way very soon.
And as always, just a reminder, this analysis was generated by an AI system purely for educational purposes. It should definitely not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.